This video is for educational purposes only and does not constitute financial advice. Always do your own research or consult with a qualified financial professional before making investment decisions. Welcome back to Understanding Money. Today, we're diving into one of the most powerful concepts in investing, asset allocation. If you've ever wondered why some investors sleep peacefully while others lose their minds over every market swing, the secret often comes down to how they spread their investments across different assets. This isn't just about diversification for the sake of it. We're talking about a strategic approach that can boost your returns, reduce your risk, and help you build lasting wealth regardless of what the markets throw at you. So grab your notebook, settle in, and let's explore why smart asset allocation might be the difference between financial stress and financial success. 1. What is asset allocation really? Asset allocation is simply how you divide your investment money among different types of assets: stocks, bonds, real estate, commodities, and cash. Think of it like planning a balanced meal. You wouldn't eat only bread, or only vegetables, or only dessert, right? Each food group brings different nutrients and benefits to your overall health. Your investment portfolio works the same way. Different asset classes behave differently in various market conditions. When stocks are falling, bonds might hold steady or even rise. When inflation hits, real estate and commodities often perform well. During recessions, cash becomes king for opportunities. The magic happens when these assets work together, smoothing out the bumps and maximizing your long-term returns. 2. The building blocks. Understanding each asset class. Let's break down the main characters in your investment story. Stocks, equities. These represent ownership in companies. Historically, they've provided the best long-term returns, about 10% annually over the past century. But they're also the most volatile. Stocks love economic growth, hate uncertainty, and can swing wildly in the short term. Bonds, fixed income. Think of these as IOUs. You're lending money to governments or companies in exchange for regular interest payments. Bonds typically provide steady income and act as a cushion when stocks get rocky. They're the calm, reliable friend in your portfolio. Real estate investment trusts, REITs. These let you invest in real estate without actually buying property. REITs often provide good dividends and can hedge against inflation since property values and rents tend to rise with prices. Commodities, raw materials like gold, oil, wheat, and copper. They often zig when other assets zag, especially during inflationary periods. Gold, for instance, is often called a safe haven during turbulent times. Cash and cash equivalents, money market funds, short-term treasuries, high-yield savings accounts. These provide liquidity and stability but offer minimal returns. Think of cash as your portfolio's emergency fund and opportunity reserve. 3. Why asset allocation is your secret weapon. Here's where it gets interesting. Studies show that asset allocation accounts for over 90% of your portfolio's performance variation over time. That's right. How you split your money matters more than which specific stocks or funds you pick. Risk reduction through non-correlation. When assets don't move in lockstep, your overall portfolio becomes more stable. While your tech stocks might crash, your bonds and gold holdings might provide a buffer. Return enhancement. Counterintuitively, a diversified portfolio often produces better returns than putting everything in the best performing asset class. This is because you can rebalance, selling high-performing assets and buying underperforming ones, essentially forcing yourself to buy low and sell high. Emotional stability. Well-allocated portfolio helps you sleep at night. When you know you're protected against multiple scenarios, you're less likely to panic and make costly emotional decisions. 4. Life stages and asset allocation. Your ideal allocation should evolve with your life. Young adult, 20s to 30s, the growth phase 80 to 90%, stocks 10 to 20% bonds. High risk tolerance, long time horizon. Focus on growth over income. Can weather market storms. Mid-career, 40s to 50s, the accumulation phase, 70 to 80% stocks, 20 to 30% bonds. Building wealth while becoming more risk-aware. Starting to think about capital preservation. May add, real estate allocation. Pre-retirement, 50s to 60s. The transition phase, 60 to 70% stocks, 30 to 40% bonds. shifting toward income and stability, less time to recover from major losses. Considering inflation protection. Retirement, 65 plus, the distribution phase, 40 to 60% stocks, 40 to 60% bonds. Income generation is key. Capital preservation becomes crucial, may increase cash allocation for living expenses. 5. Strategic versus tactical asset allocation. Strategic asset allocation. This is your long-term game plan. Based on your age, goals, and risk tolerance, you set target percentages for each asset class and stick to them through thick and thin. It's simple, effective, and removes emotion from the equation. Example: 70% stocks, 25% bonds, 5% REITs, and you maintain these ratios through regular rebalancing. Tactical asset allocation. This involves making short-term adjustments based on market conditions. Maybe you think bonds are overvalued, so you temporarily reduce your bond allocation. It can work, but it requires skill, timing, and a lot more attention. For most investors, strategic allocation wins. It's the difference between having a steady investment plan and constantly trying to outsmart the market. 6. Global diversification, thinking beyond home. Don't forget about geography. Many investors suffer from home country bias, putting too much money in their domestic market. Why go global? Different countries' economies don't move in perfect sync. Currency diversification can provide additional returns. Access to emerging markets with higher growth potential, hedging against domestic economic problems, simple global allocation, 60% domestic stocks. 30% international stocks, developed markets. 10% emerging markets. This gives you exposure to virtually every major economy without getting too complicated. 7. The rebalancing secret. Here's where the magic really happens. Over time, your assets will drift from your target allocation. Your stocks might outperform and suddenly represent 85% instead of 70% of your portfolio. When to rebalance? Calendar-based, once or twice a year. Threshold-based, when any asset class drifts more than 5–10% from target. Combination approach. Check quarterly, rebalance if thresholds are hit. How to rebalance. Calculate your current allocation. Compare to your targets. Sell overweight positions. Buy underweight positions. Use new contributions to buy underweight assets. This systematic approach forces you to sell high and buy low, the holy grail of investing. 8. Common asset allocation. Mistakes. Mistake number 1. Over-diversification. Owning 50 different investments doesn't necessarily make you safer. You can get adequate diversification with just a few broad index funds. Mistake number 2. Chasing performance. Constantly shifting allocation based on last year's winners. This usually results in buying high and selling low. Mistake number 3. Ignoring costs. High fees can destroy the benefits of good allocation. Keep expense ratios low. Mistake number 4. Emotional rebalancing. Only rebalancing when you feel good about it, rather than sticking to a systematic approach. Mistake number 5. Forgetting about taxes. Not considering the tax implications of your allocation, especially in taxable accounts. 9. Sample portfolios for different goals. The lazy portfolio, 3-fund portfolio, 60% total stock market index. 30% international stock index. 10% bond index. Simple, effective, covers the globe. The income portfolio, 30% dividend growth stocks. 40% bonds. 20% REITs. 10% preferred stocks. Focus on generating regular income. The balanced growth portfolio, 50% US stocks. 20% international stocks. 50% bonds. 10% REITs, 5% commodities. Moderate risk, broad diversification. The aggressive growth portfolio, 70% US stocks. 20% international emerging markets. 5% REITs, 5% commodities. High growth potential, higher volatility. 10. How to implement your asset allocation. Step 1. Choose your strategy. Decide on your target allocation based on your goals, timeline, and risk tolerance. Step 2. Select your investments. Use broad low-cost index funds or ETFs to represent each asset class. Step 3. Invest systematically. Set up automatic investments to maintain your allocation as you add new money. Step 4. Monitor and rebalance. Review your allocation periodically and rebalance as needed. Step 5. Evolve over time. Adjust your allocation as your life circumstances change. 11. Real-world success stories. Sarah's story, the power of staying balanced. Sarah, a teacher, maintained a 70-30 stocks-bond allocation throughout her career. During the 2008 crisis, while her friends panicked and sold everything, she rebalanced, selling bonds and buying cheap stocks. This disciplined approach helped her retire comfortably at 62. Mike's mistake and recovery. Mike put everything in tech stocks during the dot-com boom. He lost 80% when the bubble burst. He learned about asset allocation, diversified globally, and over 20 years rebuilt his wealth, and then some. The retirement couple's peace of mind. John and Linda shifted to a 50-50 stock-bond allocation as they neared retirement. During market downturns, their bond allocation provided stability and income, allowing them to avoid selling stocks at a loss. 12. Advanced strategies for the curious. Core satellite approach. Keep 80% of your portfolio in simple broad index funds, the core, and use 20% for specific strategies or individual stocks, satellites. Factor, tilting slightly overweight certain factors like small cap or value stocks based on historical premiums. Alternative investments. Consider allocating 5 to 10% to alternatives like private equity, hedge funds, or commodities for additional diversification. Dynamic asset allocation. Gradually shifting allocation based on valuations or economic cycles, but this requires skill and experience. 13. Your action plan. Assess your current situation. List all your investments and calculate your current allocation. Set your target allocation. Based on your age, goals, and risk tolerance. Identify gaps. Where are you over or underweight? Choose your investments. Pick broad, low-cost funds for each asset class. Create a rebalancing schedule. Decide when and how often you'll review and rebalance. Automate what you can. Set up automatic investments and contributions. Stay disciplined. Stick to your plan through market ups and downs. 14. The psychology of asset allocation. Asset allocation isn't just about math, it's about human behavior. A good allocation should help you. Sleep well during market volatility. Avoid emotional decision-making. Stay invested through good times and bad. Feel confident in your long-term strategy. Remember, the best asset allocation is the one you can stick with for decades, not the one that looks perfect on paper. Conclusion: your path to financial peace. Asset allocation might seem like a dry, academic concept, but it's really about giving yourself the best chance at financial success while protecting your peace of mind. It's about acknowledging that we can't predict the future, but we can prepare for multiple scenarios. The beautiful thing about proper asset allocation is that it works whether you're a hands-off investor who checks their portfolio once a year or someone who enjoys actively managing their investments. It provides a framework for success that has stood the test of time. Don't try to time the market or find the perfect investment. Instead, focus on building a well-allocated portfolio that can weather any storm and capture returns in any environment. Your future self will thank you. What's your current asset allocation? Are you too concentrated in one area? Share your thoughts in the comments, and if this helped clarify asset allocation for you, smash that like button and subscribe for more practical investing education. Disclaimer: this video is for educational purposes only and does not constitute financial advice. Always do your own research or consult with a qualified financial professional before making investment decisions. Thanks for watching, and here's to building wealth the smart way with proper asset allocation.